Hello, welcome to our next video with an FA1 recording financial transactions paper. This video will be devoted to purchase and credit transactions, and the first thing we will talk about is the accounting for purchases. We're on page 29 in the notes. When an entity buys inventory, it will use the purchases account. Now, one thing important to remember is that there is a certain approach, again, just like with the books of original entry, there is a certain approach that is taken during those exams and which you have to understand. Most of you that are familiar with accounting systems will know that when inventory is purchased, probably in your companies, that accounting goes debit inventory, credit payables. All right, and then when inventory is sold or released to production, then the accounting goes debit costs of sales, credit inventory. All right, now this is not the way that should be applied in this exam. I mean, it's absolutely correct way. However, for this exam, you're supposed to apply a simplified version of it, a version where an entity does not record all the movement of inventory. It's for small entities. Small entities will record all inventory purchases on the purchases account. So it will be debit purchases, credit payables. Now, at the end of the year, the entity will perform an inventory take. And that will determine the value of inventory to be included in end of the year statement of financial position. So rather than taking it from the T accounts, which are maintained from month to month, a small entity will probably put all inventory into purchases and at the end just take a stock take and put in the balance sheet whatever they find there. When they account for this inventory take, they will do it in the following way. They will do debit inventory, credit cost of sales. That will be called closing inventory. Now, if it's not the first year of their operations, they will probably have something from the beginning of the year, which is the result of an inventory take from last year. Obviously, to keep everything clear, they will have to get rid of it. Credit inventory, and consequently, debit cost of sales. That is the opening inventory. As a result, in the year-end statement of financial position, they will have the value from their end-of-year inventory take, and in their statement of comprehensive income, they will show some revenues whatever that number would be, and they will show cost of sales, which will be the product of opening inventory plus purchases minus closing inventory. And if you see it from the entries, debit purchases, debit cost of sales with opening inventory, and credit cost of sales with closing inventory. These three items fall in their places here in cost of sales. So that's how purchases and inventory are accounted for. If it's a cash transaction, obviously the credit goes into cash. If it's a credit transaction, the credit entry goes to payables. Now, any discounts are recorded just like in the case of receivables. So trade discounts are recorded immediately. So payables are shown net of trade discount, but gross of settlement discount. And if we use a settlement discount, then we have an item of income in our books.